So this is a question. This is an email from William. He sent this to us. So he's a listener. He said, I'm thinking about doubling down on VinFast Auto VFS as the product looks like Hyundai. Well, it's interesting. So we're happy to take a look at this company for William, VinFast Auto Limited. And so what they are is they're a Vietnamese electric vehicle manufacturer, and they went public in the US through a SPAC merger in 2023. The company manufactures electric vehicles, including sedans, SUVs, and electric buses. They began delivering their first EVs in Vietnam in 2022 and expanded later to the US market. They're also expanding to additional markets. So the symbol of the company is VFS on the NASDAQ. It's trading right now at a price of $524 and a market cap of about $12 billion. So, of course, we need to take a look at this company's products. Here's just a couple images of their vehicles, the sedan and the SUV. So they're pretty nifty looking vehicles. I would agree they do look somewhat like a Hyundai. Certainly something that I would consider driving around. But anyways, let's get into the actual fundamentals of the business and see how it stacks up as a public company. So as Ryan said, what I'm going to do here is I'm going to look at the company through the lens of KeyStone's investment criteria. And really what we tell people a lot of the time is that we have 5 main criteria that we look at when we're evaluating a company. And it's important that the company passes all 5 of these criteria. And that really just moves the company into the next stage of research. It doesn't necessarily conclude the research. You really have to drill down on each one of these points. But what they are is, first and foremost, we're looking for profitability from current operations. So a company that is actually making money on the bottom line. And this is incredibly important to us because it's the profitability that validates the business model. The purpose of a business is to make money, not just revenue, but actual earnings and cash flow. So we want to see that a company is able to do that. Second, we want to see that the company is a growing business. So that means growing its revenue and growing its earnings and cash flow per share. So there are companies out there that will grow earnings on an absolute basis, but on a per share basis, earnings will actually be in decline. As a shareholder, you own shares in the company. So it's that per share growth that is meaningful to you. A third, strong financial position. So what does this mean? That a company doesn't have too much debt. A lot of companies are able to accelerate growth in the short term by really expanding their balance sheet, taking on a lot of debt. That works great as long as their market is healthy. But the moment there's a downtick in demand, or as we've seen recently, an uptick in interest rates, that can be a major hindrance to the company. It can also it can destroy a company as well. So having a strong financial position is critical. We also, number 4, we want to see that there is a clear and achievable growth strategy. So we're always looking forward on what a company is able to do. It's fine if a company has been profitable in the past, been growing in the past, but we want to know that this growth is sustainable. So how are they going to achieve this? Is this an understandable plan? Does it have a high probability of success based on our analysis? And then finally, valuation. Is the company trading at a reasonable valuation relative to its underlying fundamentals? So we're typically looking at this on a price to earnings, price to cash flow basis. We're not necessarily looking for the cheapest companies, but we also don't want to overpay. We have some price sensitivity. So it's about buying great companies at what we consider to be reasonable prices. So let's get into this. We start with criteria number 1, and this is profitability from current operations. So I went through the financial statements here. They recently reported their Q1 financial results. And they reported a gross loss of 150 million, so losing 150 million on the gross profit line, and then a net loss for the quarter of 618 million. Last year, 2023, they recorded a gross loss of 1.7 billion and net loss of 2.4. So gross loss, what is this? It's actually highly unusual to see a company reporting a gross loss, even if they are a company that loses money on the bottom line. So companies will, of course, report the revenue figure, and then there will be specific costs associated that are attached directly to the product or service that they sell. So if you're selling a product, it'll be the raw materials that go into that product. It will be any labor costs that go specifically into building that product, and then overhead in the factory as well, specifically for construction. So this doesn't include, the sales and marketing expense necessarily. It doesn't include the rent for the head office or the management team. These are just specific costs associated with the product. And typically you're going to see this be a positive figure, even for companies that have poor financials. So in this case, with a negative gross profit, what this means is that every time they generate an extra dollar of revenue, they're actually losing more money on the bottom line. So they're losing money every time they sell a product. Now, typically companies that are losing money on the bottom line, one of the ways that they want to make up for this is they're like, well, once we achieve a certain level of volume, we'll have enough revenue that will cover our fixed costs, and we'll start making money on the bottom line. But when you have a negative gross margin, as VinFast does right now, you actually make the problem worse the more revenue that you generate. Now, I didn't look into exactly why they have a negative gross profit. This may be the case that their factories are highly underutilized. So there's a lot of overhead that is being accounted for, and then this would work itself out as they got closer to capacity. So in that case, more volume may solve the problem. But what we're looking at right now is highly unprofitable company, big gross loss, which is certainly an issue. So for criteria number 1, they get a score of 0, no profitability from current operations. Now let's look at number 2 here, growth in revenue and earnings per share. So we don't have earnings. They're generating a net loss. We don't have earnings. So right there, they're not going to get credit for that. But what does the revenue look like? So revenue growth looks pretty good. 2023 in Vietnamese currency, 28.7 million relative to 14 million in 2022. I'm not highly knowledgeable about Vietnamese currency, but this is all because this was previous to their being a public company in the US. All of this previous financial data is not in US dollars, but we had very strong growth in 2023, about doubling revenue. But in 2022, revenue was down relative to 2021. Looking at the first quarter results, so these are in US dollars, total revenues of 302 million US, representing an increase of about 270%. So very strong growth in revenue, but no growth in earnings per share because they don't have any earnings per share. So what are we going to do here? Well, I'm going to be generous here, and I'm going to give them a half point for this. I'm going to give them the half point for the revenue. I almost wasn't going to give them the half point just because we have that issue with the negative gross margin. And as they generate more revenue, I mean, the higher the revenue growth, actually, the larger the net loss. But we're gonna assume here that part of that issue again is just lack of utilization of the factories, which would potentially change as they make more sales. So they get on the board here with half a point in criteria number 2. Now, number 3, strong financial position. Do they have a healthy balance sheet? So looking at the balance sheet as of the end of the first quarter, they have cash of 123 million. They have debt of about 3 billion. This is all in US dollars. Now, typically we would look at this on like a net debt to cash flow or net debt to EBITDA basis. But again, the company does not have cash flow, does not have EBITDA. What it does have is a big cash burn. So they burnt through about almost 700 million US just in the first quarter of 2024. So I would not consider this to be a strong balance sheet. Now, if they had a big net cash balance or just, no debt, I could say that they have a strong balance sheet, even though they're not making money. But the fact that they already have debt, they're not making any money, they're actually burning through cash, they don't have a huge cash balance. So they're going to have to go back to the market to essentially just cover their expenses. That's a precarious situation. That's not what we consider to be a strong financial position. They really need to ramp up the profitability from their operations to service this debt long term. So for strong financial position, I'm giving it a 0. Clear and achievable growth strategy. So I just kind of went through the company's documentation and looked at what they're doing, what they're planning. So deliveries, vehicle deliveries for the first quarter rose 444% to 9,700 vehicles. They are launching in new markets in Southeast Asia. They're starting construction of a manufacturing facility in India. They're growing their sales network. For the first quarter in the US, they secured additional partnerships with 10 new dealers in the United States, bringing their total to 16. So significant expansion of their dealer network in the US. In March, they officially started deliveries of their C segment electric SUV to customers in Vietnam. They're also planning on expanding, doing another delivery of their VF3 model in Vietnam, as well as other models in other geographies as well. So expanding the products, expanding the geographic reach, and they have guidance for 2024 of 100,000 vehicle deliveries. Most of this to be delivered in the second half of the year. Now, they did note that the macroeconomic situation is challenging, but they still think that they're going to achieve this target. Now, if we look at where they were in Q1, less than 10,000 deliveries, and that was huge growth year over year. 100,000 deliveries for the year is substantial growth, and especially given the fact that most of this would be packed into the second half of the year. That's substantial growth, and they do have a strategy. They're benefiting from adoption of EVs. They're coming out with products. They're expanding their geographic network. I do not know about what the customer satisfaction is with the vehicle at this point. That's something, if we want to dig deeper, looking how it would compare to, like, say, Teslas or other models out there, the experience that owners have with it. Now, at this point, that's a little difficult because these are, essentially brand new entries into the market. So they're not time tested with years on the road. But anyways, I would say that this does qualify as a clear growth plan, and I think that it's achievable as well. So for this criteria, I'm actually going to give it a 1. It's back up on the scoreboard. Now, finally, reasonable valuation relative to fundamentals. Again, we would normally evaluate a company based on price to earnings or EV to EBITDA, price to cash flow, price to free cash flow. But VinFast has none of this, right? So the only thing we can really look at is revenue. Over the trailing 12 months, they've reported revenue of about $1.43 billion. If we were to look at this on a price to sales based on the market cap of $12.2 billion, that's price to sales of 8.5 times. Now, is this cheap? Well, no, I don't really consider this to be cheap. I mean, probably the best comparable we have would be Tesla. And Tesla has a price to sales of about 6 to 7 times, right? Plus, Tesla's profitable, has a much better balance sheet, much better adoption worldwide, substantially larger company. Now, you could argue that VinFast might be in a better part of their growth curve relative to Tesla. That's something that we would just basically see over time. But it's certainly, I mean, we're not looking at what I would consider to be an attractive price to sales ratio here. And then plus the fact that we can't evaluate it based on profitability, they're going to have to get a 0 for reasonable valuation. So where does this all stack up? When we add up the scores, we're giving VinFast a score of 1.5 out of 5. That is a fail by our criteria. We think that it's the company's speculative right now. Is there potential? Yes, there's potential, but there's a lot that the company has to do and a lot that the company has to prove. And let's also put this into perspective too. Pass is not 50%. Pass is 5 out of 5, right? So that is what would be required to pass this criteria test. So it's the company's a long way from that, but we'll watch next couple quarters that come out and see if they're able to hit those targets of 100,000 deliveries for the year and start driving some profitability, at least to the gross profit line, hopefully to the bottom net earnings line.
Yeah. So I was just reading the conference call as well. So, one of the questions that they got from analysts is, when is your target going to reach gross profit break even? And they say, we remain to target gross profit margin break even by 2025. And they go on to say like a lot of like material costs are kind of holding them back. But again, like you just said, so they're targeting gross profit margin break even by 2025. That's gross profit. Again, like that's not
That
bottom
is
line.
gross.
So
That's gross. Yes.
Yeah,
Yeah,
it's
it's
gross.
just
That's
gross.
gross.
So-
And that's actually so and that's by 2025. So even with 100,000 deliveries this year, they're still they're still looking at negative gross profit. So this is a company that is going to have to raise I'm coming to the opinion that they're going to have to raise a significant amount of capital over the next couple of years through debt, through equity issues.
Yeah,
they're,
exactly. I
they're
was also
very
reading
far from profitability on the bottom line.
Exactly. I was also reading that in here just because, again, we expect around some CapEx between 1 billion and 1.5 billion in 2024 for those manufacturing facilities. We plan to fund this using our liquidity reserves as mentioned above, and if needed, from the new funding resources combining equity and equity linked. So, I mean, yeah, like exactly like you said, they're probably going to be doing a raise here to fund that.
Mm-hmm.
The other concern which I see here is related party transactions. Normally, this isn't something which you need to worry much about, but 56% of their EVs were related parties to the company, and then 24% of their scooters were as well. So you're wondering, what is this related party?
Mm-hmm.
It's a taxi company that is owned by a chairman of the company. So if that company, you need to figure out that relationship as well. And that company is not public, so you can't see if their financials are doing good. So if they just fell off, there goes effectively half their EV sales at this time.
And with these related party transactions, you also want to make sure that money is actually exchanging hands.
Yeah, and that
Not
also
saying it
brings
isn't,
into the...
but like these are things you dig deeper in. But I mean, I would say, we wouldn't even bother digging in that area at this point because there's so many other areas where it falls short.
Mm-hmm.
Yeah, I think it's a good summary.